Imagine waking up one day to find your 401k, your retirement nest egg, invested in risky private equity deals or hedge funds you barely understand. Sounds like a plot twist, right? Well, it's not fiction. President Donald Trump is reportedly planning to shake up the $12 trillion 401k market with a new executive order.
That's right, Henry. This could change how millions of Americans save for retirement, potentially opening the door to bigger returns or bigger risks. Welcome to IRFM News, where we break down the big stories that impact your money. Today, we're diving into what this 401k overhaul means for you.
Buckle up, folks. Let's get into it.
Hey, everyone. Welcome to IRFM News. I'm Sarah, and I'm here with my co-host, Henry, to unpack the latest financial headlines with clarity and a touch of real talk. You can find us on YouTube at IRFM News. Hit that subscribe button if you want to stay ahead of the curve.
Absolutely, Sarah. Today, we're tackling a huge story that's got everyone from Wall Street to Main Street buzzing. President Trump's reported plan to open up 401k retirement plans to private assets. This is a game changer, and we're here to break it down in plain English. No jargon, no fluff, just the facts you need to know.
So, Henry, let's set the stage. What's going on, and why should our listeners care?
The big picture, what's happening? All right, let's start with the headline. According to reports from the Wall Street Journal and Bloomberg, President Trump is finalizing an executive order that would allow 401k plans, those retirement accounts millions of us use, to invest in private assets. These are things like private equity, venture capital, real estate, and hedge funds.
Okay, hold up, Henry. For those of us who aren't finance nerds, what's a 401k, and why is this a big deal?
Great question, Sarah. A 401k is an employer-sponsored retirement plan. You put in money from your paycheck before taxes, and often, your employer matches some of that. That money gets invested, usually in stocks, bonds, or mutual funds, things traded on public markets like the New York Stock Exchange. It's been the backbone of retirement savings for millions of Americans, with about $12 trillion parked in these accounts.
12 trillion? That's a lot of zeros. So, what's changing?
Right now, 401ks are mostly limited to those public market investments because they're considered safer and easier to regulate. But this executive order would let 401k plans invest in private assets, investments that aren't traded on public exchanges. Think private equity firms buying up companies, venture capital backing startups, or hedge funds making big bets on real estate or other assets.
So, it's like letting your retirement savings play in the high-stakes world of Wall Street's elite investors?
Exactly. The idea is to give everyday folks access to investments that have historically been reserved for the ultra-wealthy or big institutions like pension funds. But here's the catch. These private assets come with higher risks, higher fees, and less liquidity, meaning you can't easily cash out.
Okay, that sounds like a double-edged sword. Higher returns sound great, but higher risks? That's got me a little nervous.
You're not alone, Sarah. This move is a win for the private equity industry, which has been lobbying for years to tap into that $12 trillion 401k market. But not everyone's cheering. Some experts are waving red flags, saying this could expose regular savers to risks they're not ready for.
Let's break it down for our listeners. Why is the private equity industry so excited about this? And what's got the skeptics worried?
Why it matters, pros and cons. All right, let's dive into the why. The private equity industry sees this as a golden opportunity. They've been pushing for access to 401k funds because it's a massive pool of money, $12.5 trillion to be exact. That's a lot of potential fees for them and a chance to grow their business.
Fees? I'm already side-eyeing this. What kind of fees are we talking about?
Good catch, Sarah. Private equity investments often come with management fees that are way higher than what you'd pay for a typical 401k mutual fund. For example, the average expense ratio for a stock mutual fund in 2024 was about 0.4%, but private equity fees can be 2% or more, plus additional performance fees. That's a big chunk of your savings over time.
Ouch, so the private equity folks get richer. But what's the upside for regular people like me?
The big argument from supporters is higher returns. Private equity has historically outperformed the stock market in some cases. From 2000 to 2020, private equity averaged about 10.5% annual returns, compared to the S&P 500's roughly 7 to 8%. The pitch is that letting 401ks invest in these assets could help you grow your retirement savings faster, especially if you're younger and have time to ride out the ups and downs.
Okay, I like the sound of bigger returns, but what's the downside? There's always a catch, right?
Oh, there's definitely a catch. Private assets are riskier. They're not traded on public markets, so they're less transparent. You might not know exactly what you're investing in. They're also illiquid, meaning you can't just sell them if you need cash. Plus, private equity deals often involve companies in distress, which can lead to higher bankruptcy rates. For example, 7 of the 10 largest corporate bankruptcies in Q1 2025 were private equity-owned companies.
Yikes, that's not exactly reassuring. So my 401k could be tied up in a company that goes belly up?
Potentially, yeah. And here's another worry: fees and complexity. Private equity investments are complicated, with layered structures that can be hard for the average person to understand. Critics like Senator Elizabeth Warren have pointed out that these investments often lack the transparency and protections that 401k savers rely on. She's even called out companies like Empower for pushing these products without clear safeguards.
Empower, huh? Aren't they a big player in the 401k space?
Yep, one of the biggest. Their CEO, Edmund Murphy, is all in on this, saying it's a landmark initiative to diversify portfolios. But skeptics like Jeffrey Hook from Johns Hopkins say private equity and 401ks could be suboptimal for retirees, especially if high fees eat into returns, or if an economic downturn forces people to tap their savings early.
Okay, so the private equity industry is like, trust us, this is great. But experts are saying, hold on, this could be a disaster for regular folks. What's the government's role here?
The executive order would direct the Department of Labor and the Securities and Exchange Commission to create guidelines for employers and 401k plan administrators. The goal is to make it easier and legally safer for them to offer private assets. Back in 2020, Trump's first administration issued a letter saying private equity could be allowed in some cases, but uptake was slow because employers were worried about lawsuits if investments tanked. This new order might give them more protection.
So it's not a done deal yet?
Not quite. The details are still being finalized, and there's no set date for Trump to sign it. But the buzz is that it could happen soon, maybe even this week.
All right, I'm starting to get the picture. This could mean bigger returns for my 401k, but it's a gamble, and I might pay more in fees. What's the history behind this push? Has this been brewing for a while?
The backstory and industry push. Let's rewind a bit. This isn't a totally new idea. Back in 2020, during Trump's first term, the Department of Labor issued an information letter saying 401k plans could include private equity in some cases, as long as it didn't violate federal regulations that require plan managers to act in savers' best interests. But the Biden administration pumped the brakes, urging caution without fully reversing the policy.
Why the caution?
The Biden team pointed out the risks we've been talking about: high fees, low liquidity, and the potential for losses. They didn't ban private equity and 401ks, but they made it clear that plan sponsors could face legal heat if things went south. That scared a lot of employers off, so the idea didn't gain much traction.
And now Trump's back, and the private equity folks are seeing their chance?
Exactly. The private equity industry has been lobbying hard for this. They donated over $200 million to Trump's 2024 campaign, so they've got some influence. Firms like Blackstone, Apollo, and BlackRock are already teaming up with 401k providers like Vanguard and Empower to create products that include private assets, like target date funds with a slice of private equity.
Wait, target date funds? Those are the ones that get more conservative as you get closer to retirement, right?
Yup. They're designed to be a set-it-and-forget-it option for most people. The idea is to mix in a small amount of private assets, say 10%, to boost returns without going overboard on risk. BlackRock and others are betting this will make private equity more palatable for 401k savers.
Okay, but 10% still sounds like a lot if these investments are so risky. What's the industry saying to convince people this is a good idea?
They're leaning hard into the diversification argument. Brian Corbett from the Managed Funds Association says opening up 401ks to private assets will give Americans the diversification and investment options needed to build wealth and save for a successful retirement. They argue that public markets are shrinking. There are about 3,000 fewer public companies today than 30 years ago. So private markets are the future.
That sounds like a sales pitch. Are regular people really clamoring for this?
Not really. Most 401k savers aren't out there begging to invest in private equity. This push is coming more from the industry than from Main Street. Critics like Caleb Silver from Investopedia say regular savers should cap private investments at 10% of their portfolio because anything more is just too risky.
So, the industry's driving the bus here. What's the bigger economic context? Why now?
Great question. Private equity's been struggling lately. High interest rates have made it harder for them to do deals, and traditional exit strategies, like selling companies or going public, have dried up. There are thousands of private equity-backed companies waiting to be sold, and firms need new money to keep the wheels turning. The 401k market is like a shiny new piggy bank for them.
That's a little unsettling. It feels like they're using our retirement savings to bail out their business model.
That's the concern for some. Moody's Investors Service even warned that letting retail investors into private markets could pose systemic risks if things go wrong. But on the flip side, some argue that 401ks are a long-term investment, so they're a good fit for illiquid assets like private equity, especially for younger savers with decades until retirement.
What should you do? Practical advice. All right, Henry, let's get practical. If this executive order goes through, what should our listeners do? Should we be excited, scared, or just wait and see?
First off, don't panic. This isn't happening overnight. Even if Trump signs the order, it'll take time for employers and plan administrators to roll out these options. Most experts think private equity will only be a small part of 401k portfolios, maybe 10%. So it's not like your entire retirement is going into a hedge fund.
That's a relief. But what should we look out for?
3 big things: fees, risks, and your own goals. Check the fees on any private asset options in your 401k. If they're eating up your returns, it might not be worth it. Second, understand the risks. Private equity can be a roller coaster, and you might not be able to access your money when you need it. Finally, think about your timeline. If you're 30 and have decades until retirement, a little private equity might make sense. If you're 60, you probably want to stick with safer bets.
That makes sense. I'm in my 40s, so maybe a small slice of private equity could work, but I'm not betting my whole nest egg on it. What about talking to a financial advisor?
Definitely a smart move. A good advisor can help you weigh the pros and cons based on your specific situation. Also, keep an eye on your 401k plan's offerings. If your employer starts adding private asset options, ask questions. What's the fee structure? What's the track record of the fund? How much of your portfolio is going into it? Knowledge is power here.
Totally agree. And let's not forget to stay informed. Things like this executive order can change fast, so keep up with trusted sources. Speaking of which, you can follow us at IRFM News on YouTube for updates on this and other financial stories.
Absolutely. And one last tip. Don't let the hype sway you. Private equity sounds fancy, but it's not a magic bullet. Stick to a diversified portfolio, keep your costs low, and focus on the long game. That's been the recipe for retirement success for decades.
Well said, Henry. All right, before we wrap up, any final thoughts?
Just this. Your 401k is your future, so treat it with care. This change could open new doors, but it's up to you to decide if they're worth walking through. Stay curious, stay cautious, and keep learning.
Wow, Henry, that was a lot to unpack. This 401k shakeup could be a big deal, and we'll definitely be keeping an eye on it. Thanks for breaking it down with me today.
My pleasure, Sarah. And thanks to all of you for tuning in to IRFM News. If you found this episode helpful, give us a thumbs up on YouTube at @IRFM News and hit that subscribe button to catch our next deep dive.
We love hearing from you, so drop a comment below with your thoughts on this 401k change or any other financial topics you want us to cover.
Until next time, keep your money smart and your retirement dreams big. See you soon.
Bye, everyone.